go. Hopefully, everybody had an opportunity to get through the reading for Solid Footing Chapter 1. And hopefully we could make sense of anything that maybe didn't quite click for you and walk through a few examples and do a little accounting today. Before I get into that, those of you that read the chapter, does anybody have any questions that they want to throw out there or talk about before we get into it?
So I have a question about the Excel stuff.
Mm-hmm.
So when I clicked on the link that's in the Canvas, I couldn't type in any of the numbers on the Excel. Is there something else I need to find on the website?
Yeah. Let me show you what you need to do there real quick. I'm going to go ahead and share my screen and so everybody can see what I'm doing. We'll maybe answer that question real quick, and if anybody else has questions, we'll tackle those too. We need screen number 2. Everybody see that okay?
Yep.
Perfect. Let me get my windows set back up here. And every time I share my screen, all my windows get jumbled up for some reason. They haven't figured out how to fix that part in Canvas yet. So let me pull my windows back up here. My meeting controls. There we go. Put my chat back up. I can see what's going on there. What's that? Perfect. Okay. So the question was, when you open those Excel spreadsheets that I've put into Canvas, they don't seem to work when you first open them. So let me show you what you need to do. There's a little trick. Everybody see the spreadsheet right there?
Yep.
Okay. You'll notice along the top it says Protected View, and there's a little Enable Editing button at the top. You have to click that button to get it to work. If I click Enable Editing, it will open that spreadsheet up where I can get in and do something with it. Now, what I recommend you do as soon as you do that is give your spreadsheet a home. I don't want you to put in a bunch of stuff for homework and then have it disappear if the computer locks up or if the power goes out. And so when you unlock it, just go to File, Save As, and save that file somewhere on your computer where you can get to it if you need to, and kind of save as you go along. But that's how you open them. If you don't do that, then you won't be able to do anything in it. So give that a try, Ethan, and if that doesn't work for you, then we'll figure out something else.
I just didn't know if there was something else I had to download.
Yeah, you got to appease the Excel gods by clicking the right buttons. Otherwise, they won't let you in there. Bryce had a question on the chat. He said mine also wouldn't work. Used the link you sent out and downloaded. And then when I try to do the assignment, it shows a pop-up. Bryce, when you said the link in the email I sent out, is that the announcement I sent out today about the software download? Just want to make sure I'm clear before I try to guess as well. Okay. That should give you a physical download of the software. If that's not working out for you, you're going to have to contact our tech department. If you can give me till the end of class after we're done here, I'll shoot you the information so you can get a hold of them. And then we had a hand up here. I think that was Bryce right there. Okay. Anybody else?
Yeah, I have a question too.
Oh, okay.
So it goes with what Bryce said. I opened it and it says I log into it, and then I log into it and it doesn't say it downloads. So I don't it says it works, and then I hit activate and enable editing, and it says I have to buy the subscription.
Okay. And so it sounds like you're having kind of a similar issue.
Yeah.
With getting that to work.
Yeah.
Do you have Excel installed on your computer?
I have a Microsoft computer, but I don't think I have Excel.
Okay. You might try to do that free download also. If you're using it, the Office 365 has a web browser kind of functionality where you can open the spreadsheets on the web and through a web browser, and it doesn't really play well with the macros in these spreadsheets. You really have to have the standalone program installed on your machine. If you don't have that installed, you're probably going to run into some problems. And so I'll kind of send you that route too with the link that I sent out. And if you can't get that installed and working, I'll direct you to the tech department. I know that's not a very satisfying answer, but that's kind of software installs and whatnot are beyond my pay grade. Anybody else have anything that they want to throw out there before we move on? Okay, Ryan, what do you got? Unmute yourself, Ryan.
That spacebar thing, sorry.
Yeah.
Anyway, the assignments at the end of the chapter there, that's due next week. That's like today's assignment, right? Am I reading that right?
Right. So
Okay.
On that assignment, I've got August 31.
Okay.
Which gives us a couple of days to kind of wrap that up.
I wanted to go through it. Like, I feel like I understand, but I'm glad we'll have more time to talk
Yeah.
about all that stuff. So thank you.
Yeah, usually what I'll do, is we'll start an assignment or introduce the material you need to do the assignment, and then you'll have a little bit of time to kind of take care of it. I got another question. So let's see, it looks like that is Hunter. On that one, Hunter, what do you got?
Yeah, no. So I went through the solid coding chapter 1, but it's like very difficult to understand it if you're not doing the Excel thing. So I went through it and read as best as I like could understand, but I couldn't really do like the action of like moving the money over and then having it subtract and all that. Understood like for the most part of what's going on, but that would definitely help.
Okay, perfect. Yeah, and that's exactly what we're going to go through today. We're going to walk through the steps in kind of going through and setting up this accounting system. I'm going to walk you all through the transactions, and we'll go as slow as you all want to go or as quick as you all want to go. If I'm going too fast, slow me down, stop me, ask questions. But I liken accounting to building a house. And any of you all that have ever worked in construction, and I did concrete and construction for a couple of summers in college. Any of y'all that ever done that kind of work know you have to have a solid foundation. And if you don't have a solid foundation, you try to put up walls and you try to put up a roof, it's going to collapse on itself. So what we're doing here in the first couple of weeks of accounting is building a foundation. So these first couple of weeks are critically important. And this is the time in these first couple of weeks is if you don't understand something or if you have a question, then let's stop and talk about it. Because if you say, I'll catch up later on, well, you're going to have some problems. So this is kind of the, I don't say that to scare anybody. We're not going to be talking about things that are, brain surgery, rocket science difficult, but it's important to get the fundamentals down before we move on. So we'll hopefully start that process today. I put some notes up here that I'm going to go through. If you had a chance to download those and print those off, that's great. You can kind of use those as we go along to fill in blanks. If you didn't print them off or you can't print them off, I recommend just get some paper and have a pen handy so you can kind of jot down as we go along. I think you'll find that helpful. Anybody else, anything before we kind of jump into this and get going? Okay. What's the feeling out here? Is it nervous? Is it excitement? Is it dread? What are the emotions here?
I feel pretty good about this. I actually asked my wife how to do Excel. She knew, so I feel like I had that advantage. But once I got it rolling, it was actually fun to go through chapter 1. I enjoyed it, and I feel a little better about this course now.
See, so there we go. Ryan has made it through chapter 1. He's still here. He's still smiling. So those of you that maybe haven't, there's hope. It's not a lost situation by any means. I'm going to go ahead and pull up my notes and get my little handy writer pen out here so we can maybe jot a few things down as we go along, and we'll see if we can make some accounting happen here. Anybody have a preference for what color pen I use? Ink. I got blue. Let's see. I got all kinds of colors here. We'll go pen, and we'll go. Let's see. We got maybe like a blue. If I do blue, everybody see that okay?
Yeah.
Okay. We'll get the old tablet out here, and we'll get going. Perfect. All right. So The whole beginning idea around accounting, and what the book's trying to do is introduce layman's terminology, things that we can all say and be familiar with, and then we'll kind of add the accounting to it. So the whole beginning of chapter 1 starts off with this idea of an equation. And our entire world of accounting is built around this equation. And the equation the book presents to you is stuff equals claims to stuff. And even if you're not a good math student, we talked on Tuesday about how some of us are a little bit hesitant about math. Even if you're not a really good math student, I bet you know this one thing about equations. Equations always have to be what on both sides?
Equal.
Yeah, they have to be equal. They have to be in balance. It's the exact same thing here. So on one side of my equation, I got stuff. On the other side, I've got claims to stuff. Who owns the stuff? So, just kind of give you a real simple example, and you all can probably relate to this. Maybe you've got a vehicle sitting out in your driveway. I've got a black Tacoma pickup in my driveway. I love my taco pickup very much. We go way back. But I had to go out and buy that, obviously, and I'm just going to kind of throw a number. I can't remember the exact number, but just for the sake of argument, I'll say that pickup ran me $30,000. So I have $30,000 worth of stuff sitting out in my driveway. When I went and bought that truck, I made a down payment on it. And I've been paying on it for about 4 years now. And so like one more year and it's really mine. And so again, just to kind of make up a number here, let's say that all told, I've paid $20,000 towards that truck. As the owner of that truck, I have a $20,000 claim to it. And that equation doesn't balance, does it? 30,000 doesn't equal 20. So there's something else going on here. The bank still has a $10,000 claim to my truck. If I don't pay my truck loan, they'll come and take it from me. And then I have zero stuff and I have zero claim, right? And so it's the same with your mortgage. It's the same with your vehicle maybe. But the idea is the stuff that you own, whether it be personally or as a business, is always equal to who has a claim to it. You as an owner or a creditor. Right on? That kind of makes sense? So that's kind of the first big idea that our book introduces. And of course, not everything we own, someone else has a claim. That's not the case. Let me give you an example. I'm a baseball guy, and I used to collect baseball cards when I was growing up. And I quit when I turned like 15 and got interested in girls because you can't do the girl thing and the baseball card thing at the same time. So I gave that up. But as I got older, every now and then I would see a player and think, they're going to be really good. And I would buy one of their cards just to kind of keep. So a long time ago, a while back, I saw a guy named Joey Votto playing in Dayton. And I thought, well, he's going to be a good player. So I got on eBay and bought his card. And I paid, I just made $50. So I have a claim to that card of $50. No one else has a claim to it. The bank did not loan me any money. And nobody else gave me money, so my claim is the entire claim on that card. Now that card, for some reason when the pandemic hit, memorabilia and sports stuff went through the roof. And that card is worth maybe 3 or 4 times what I paid for it. But my stuff I still value a lot of times in accounting by what I paid for it, because that's a solid number that I can verify. So, the equation, maybe just stuff equals my claim. There's no other claim that anybody else has. So I asked you all on Tuesday, so we do a little accounting show and tell. And I said, grab something for accounting show and tell. And Mary freaked out. She's looking around the room. She didn't know what she was going to do. So now's the time. If you have something for accounting show and tell, if you could tell me what you have and maybe, I don't want to get too nosy, the price of it and who has a claim to it. Anybody want to throw one out there? Okay, Mary, go ahead.
So my youngest daughter is doing the Pacific Crest Trail. They started out May 5th. Mm-hmm. And so she knows I'm a worrier. So she bought this handy little satellite phone. And so every morning when she gets up, she turns it on. so I can keep track of her.
Oh, okay. Wow. Okay. That's awesome.
And then I know she's alive. So they're all the way up into Oregon now from Southern California. So that's priceless to me right now.
Okay.
So
Well, priceless as though it may be to you, Mary, I'm going to go ahead and make up a number and put to it. We'll say Mary's
$1
satellite.
trillion.
$1 trillion. Satellite phone. 1 trillion. And her claim is 1 trillion. I'm guessing you don't owe the bank any money for that, right?
No.
Anybody else have one they want to throw out there?
I have one, but it's not really small.
Okay.
This is my remote controlled car, aka an RC. When you first buy it, it's worth about $300.
Okay.
But me, I put in all these upgrades, like different control arms and shocks and drive shafts and tires to make it perform better. And my total investment in it is probably
Okay.
$550 to $600.
All right. So it's really interesting. And we actually get to this later on. This is like an important thing in accounting. What happens when we buy stuff and then we add to it? Is that new stuff or is that just a continuation of the old stuff? And that's a really important thing in accounting. We actually studied that quite a bit later on, so I'm glad you threw that out there. We'll consider the original RC car here. And we said $300.
Yeah.
Now, Ethan, is that claim all yours, or maybe did somebody loan you some money to get that?
That's all me.
It's all Ethan. All right.
I found the thing in an old bin out in the garage and just over time started putting these better parts on it.
Okay. All right. And so you kind of get the idea there. A lot of what we're doing in accounting revolves around this idea of the stuff that we own is equal to who has a claim to it. Are we okay on that point?
Yep.
Awesome.
Yes.
All right. Thank you all for sharing that. So another key point again, if you're taking notes, you want to play along here again. I'm a big write stuff down, put pen to paper guy. Our stuff that we own is equal to the claims to stuff. Who has a claim to it? It can be you or whoever's an owner. You know, businesses have lots of owners in some cases. It could be the owners, or it can be a creditor. It could be a bank. It can be someone that has loaned money to you. All right, so that's important point number one. In our chapter, they set us up with kind of a simple little accounting system to show you how all this accounting stuff works and how it comes together. And they use an example of a money bucket by the door. And I've recreated the money bucket right here behind me. The money bucket by the door. You and your sibling are going to put money in the bucket to kind of have money pulled together so you can use it to go out and have fun with. And so you pulled your money together, you stuck it in the most logical place you could possibly put a bucket of money, right by the front door. And every time you go out, you're going to take money out of the bucket and go out. Well, we need an accounting system to keep track of that bucket of money. So the accounting system that we've developed for this bucket of money is not really any different than the accounting system that we have at Walmart or at Target or Netflix or Ford or any of them. Or, you know, a small business like Holtfield Station. The accounting system is designed to keep track of the stuff we have and let us know who has a claim to it. I mean, that's essentially what an accounting system does, and that's what our bucket of money is going to do for us. So, we're going to set up our accounting system. We're going to have stuff on one side of the equation, and we're going to have that be equal to our claims to stuff. Who has a claim to it? We have one thing of stuff right now. I'm going to call that an account. We have an account for our cash bucket. Right? We have a bucket of money. That's stuff. If we were keeping track of vehicles, we'd have an account for vehicles. If we were maybe a guitar store, we'd have an account for inventory. And that would be stuff. Then we have claims to stuff. Who has a claim to it? We have my claim as an owner of the bucket. And we have a sister who has a claim. So we have 3 accounts in our high-tech accounting system here. We have a bucket of stuff, of money, and we have 2 people that have a claim to it. So we'll set it up just like that. We've got 2 transactions that we're going to put in to begin with. And I'm just going to label them 1 and 2. Transaction number 1, I put 200 into my money bucket. So I'm just going to put a 1 right there. $200 going in, plus 200. Now when I do that, if I don't do anything else, my accounting system's not in balance. And that's not good. We got to have accounting harmony here. So on that other side of the equation, I have to put $200 somewhere. Since I'm the one that put the money in, I'm going to add that 200 to my claim. Plus 200. Right on? Make sense? All right, sister comes along. She says, hey, a bucket of money by the door sounds like a great idea. I'm going to put $150 in. So she comes along. And she says, I'm going to drop 150 in. I don't have a claim to that 150. It wasn't my money. I didn't put it in the bucket. I didn't invest it. My sister did. So her claim is going to go up 150. So, and do some of that hard math here that I was telling you didn't exist. What do we have in stuff right now? How much I got in the cash bucket?
Well, you have 200.
Yeah, so
3.
total.
350. Oh, you.
Thank you. If I count up all the money in the cash bucket, you were technically right. My claim is 200. But if I count up all the money in the cash bucket, I've got 350. So I have 350 in stuff. And the claim to that stuff between my sister and myself, 350. So we got a nice little accounting system going on here. We're able to keep track of the stuff we have and who has a claim to it. So everybody get that down okay? Awesome. The other thing we do in accounting, right? We do these transactions, we put them in the accounting system, and then we have to summarize them. Most of the time that happens at the end of the month, maybe at the end of the quarter, or at the end of the year even. But we have reports that we make that summarize everything in that accounting system. So our first report that I'm going to show you, and we're just going to call it right now a report of stuff and who has a claim to it. Very high-tech, fancy title there. We said we had 350 in cash, which is the only stuff we have. So our total stuff is 350. My claim, 200. Sister's claim, 150. So we have 350 in claims. My stuff is equal to the claims to stuff. So if somebody were to come along and say, hey, I'm the money bucket auditor. I want to see a report that shows me who has, how much of stuff you got and who has a claim to it. I could run them that report and they'd be happy. So, all right, everybody get that part down okay? We good there? Perfect. So to kind of continue that, I'm an owner, my sister's an owner, and now here comes Dad. Dad says, you know, I've heard about the money bucket. I want to loan you all some money. You're such responsible kids putting this bucket of money by the door, and I see no problem with lending you some of my money. Now, Dad's not an owner. He's a creditor. He wants to be paid back. So we're going to add a few more transactions here. And we're going to get Dad involved, and we're also going to pay back some of what we put, or take out some of what we put in. Okay? So we're going to set up our accounting system again. add a few new transactions and one new account. On the stuff side, I got that cash bucket, nothing else but that. On the claim side, I've got my claim. I've got my sister's claim. And now I've got a new one. I've got Dad involved. Dad now has a claim. But he's not an owner. He does not own the bucket. He may own the roof over the bucket. He doesn't own the bucket. All right. So 1 and 2, we got that down. We put 200 in, just like we did before, just copying those transactions. I put 200 in. My sister puts 150 in. Put my little plus sign on there so we know plus 150. Plus 150. All right. Now, Friday night, sister wants to come along and take out some money. She has big plans. She's going to have as much fun as you can possibly have on 20 bucks. And 20 bucks now, as an adult was basically like $1 was when I was a kid. So I'm not sure how far she's going to get. But sister's going to come along and she's going to take out 20 bucks. Okay? So our third transaction, we're simply going to take out 20. What do you think is going to happen on the right-hand side of the equation? Anybody want to throw a guess out there where the other side of that transaction is going to be?
The sister's claim is going to subtract 20.
Yeah, perfect. Thank you, John. We're going to put a 3 right there. We're going to drop sister's claim down 20 bucks. We're still in balance. She took money out. Her claim goes down.
Yeah.
Perfect. Same idea on number 4. You're going to come along and you're going to take 15 bucks out. Somebody pointed out one year, we were doing this example, and they said, this isn't me, I'm just telling you what was said. It's just like women to spend more than the men. And I said, what an awful thing to say. That's not true. Come on. But in this case, it did happen. I come out, I take out 15. I go to Taco Bell and I buy $15 worth of nacho fries. My claim goes down 15. So now if we're looking, my claim is 185. My sister's claim is 130. 185, 130 is like 315, I think, if you add those together. So our cash bucket has 315 in it. The equation is in balance after every transaction because we're doing stuff on a plus and on both sides, and minus on both sides in those cases. So now Dad comes along. Dad says, hey, here's $100. Throw it in the money bucket, pay me back as you can, no interest, because I'm a good dad. So our money bucket goes up by 100, and now Dad has a claim. So money's coming in, money's going out. It's pandemonium around the money bucket on Friday nights. People grabbing the cash to go out the door. This example is going to be obsolete in a year or two. Now, I went to the Reds game the other day. If you've ever been to the Reds game, they have the strawberry lemon chill. They're like the little frozen lemonade things you can get in a little cup. And there's only one place that sells them. I used to vendors would walk around and give them to people. You can buy them. But now there's like one little cart in the stadium where you can get these things. That's the only place. So I went up to buy some, and I said, I get one for the whole family, 3 lemon chills, and I had my 20 out. It was $6 a pop. I was going to give the guy a $2 tip and my $20 bill, and he put them up on the table, and I tried to hand him my $20 bill, and he looked at me like I had a third arm growing out of my head. He said, no, none of these people take cash anymore. Got to use your card. I said, okay. So I fully expect in like a year or two, when I say cash bucket, everybody's going to be like, cash bucket? What do you mean cash? I don't even use that anymore. It's all credits and tokens on the computer. But number 6, here's the big one. We'll see if you have your thinking cap on here. We take $25 out of the bucket and we pay back dad. First part of that's going to be easy. We take 25 out of the bucket, minus 25, and pay back dad. And so we'll see if you got your accounting brain tuned here. Where's that going to come out on the claims to stuff side?
One of that.
Yeah, his claim goes down $25, doesn't it? Dad's claim, we paid him back, so his claim goes down. He doesn't have a claim to that 25 anymore because he got it back. That's an important point because a lot of people, they'll want to try to take it out of my claim or my sister's claim. No, it comes out of dad's claim. We paid him back, so he doesn't have a claim anymore. All right, let's go ahead and do a little math here. Let's see if our accounting system is really imbalanced. Anybody want to, let's see, we'll add up the cash. My claim is 185. Sister's 130. Dad's is 75. So I'll use my old handy calculating machine here. I get 390 on the claims side. Anybody got a number on the cash bucket there?
390.
390. Okay, perfect. So we have achieved accounting harmony. The accounting system is in balance and everything is great. A very simple accounting system. Money comes in, money goes out. We track who has a claim to that money as it goes in and out. Are we okay with that idea? Okay? Perfect. So the reason the book gives you that scenario, they want to give you something very tangible that you can latch onto, because everything we're going to talk about, at least in the first chapter, is going to be based on that idea. All we're going to be doing is taking and putting accounting terminology into the generic kind of stuff, claims to stuff terminology. So we're going to make a little transition here and start using some accounting terminology. Earlier, we did a report called Stuff and Claims to Stuff. In the real world, that report's called a balance sheet. And this is what we call one of the financial statements that a business produces. The balance sheet is basically an accounting report that shows us what we own and who has a claim to it. It shows us stuff, it shows us claims to stuff at a specific point in time. And just like the report I showed you before, it always has to be in balance. So we said, what was it, 390? Yeah. 390 in our bucket. Total stuff of 390. I had a claim. Dad had a claim. Dad's claim was 75. My claim was 185. Sister's 130. So 390 claims to stuff. Total stuff is equal to claims to stuff. It balances. That's why they call it the balance sheet. If it doesn't balance, you have an unbalanced sheet. And that's not a thing. You just made accounting mistakes. So the balance sheet balances. The stuff equals claims to stuff. So that's what we'll call it. We'll call that report the balance sheet, not the report of stuff. What we own, who has a claim to it. Kind of pause there. Let everyone catch their breath. Let everyone, we're all excited. Accounting's happening. Thursday at 3:30, I know, right? Hardly contain myself. feels like you're getting the keys to some mystical business kingdom here. Any questions up to that point?
No.
Okay. So let's get real with it. Stuff is not really what they say in the real world. If you're eating dinner tonight and you try to initiate a conversation about accounting and you're talking about stuff and claims to stuff, you're not going to impress anybody because that's not what they use in the real world. So we're going to give you the accounting terminology to go along with what we just had from a concept standpoint. In the real world, we call our stuff assets. You gotta be careful in accounting. Yeah, I'm an efficiency guy. I like to abbreviate sometimes, but in accounting, you gotta be careful when you abbreviate, especially with a word like that. So your best bet, you gotta spell assets out. Don't abbreviate it. Just spell the whole thing. I don't want anybody to get in trouble. But we call our stuff an asset. Okay? So your home is an asset. Your vehicle's an asset. Your RC control, your RC car is an asset. Guitar is asset. You know, all that stuff you own personally would be an asset. Same idea for businesses. You think about Walmart, those cash registers, assets. The parking lot, the lighting in the parking lot, assets. The inventory, assets. Okay? Claims to stuff by people who are not an owner. Not an owner, but they have a claim. We call those liabilities.
Right.
Chances are you are liable for something, whether it be a loan to the bank. Maybe there's a party or a wedding coming up and you said, hey, I'll make a cake. You're liable to make a cake to somebody, okay? So when you are liable to someone, you owe them something, whether it be money or some kind of service or some kind of thing you're going to do for them. And then finally, claims to stuff by the owner or the owners of an organization. We call that owner's equity, which is kind of redundant because equity means ownership, but we're saying owner's equity. So we're really saying ownership, owner's equity. All right. So that's it. The assets, what we own, is equal to the claims. It's a liability. We owe somebody some money, or it's an owner claim. We own it. We have the claim. So that's how the terminology is going to shift to. All right. Our new equation, the accounting equation is what I'm going to call it. The accounting equation right here. Assets equal liabilities plus owner's equity. The stuff we have is equal to the claims. Assets equal liabilities plus owner's equity. And the cool thing I love about accounting, I don't know if you ever had classes where you take an introductory class and then maybe 2 or 3 classes later they tell you how things really are. You ever had classes like that? I think it's a math class or history class or whatever. We're sitting here in really the first night of entry-level accounting. This accounting equation is the same whether we're sitting here at Southern State in this class in Accounting 101 or you're sitting in the doctorate program at Ohio State in Accounting 600. The accounting equation, assets equal liabilities plus owner's equity. This is something that you need to understand and commit to memory because a lot of accounting revolves around this idea. And if you have a solid understanding of that equation, everything else is gravy. Okay? So assets equal liabilities plus owner's equity. I don't know why I have a blank slide in there. Probably at some point when I gave this lecture, I said some kind of profound thing about the accounting equation. So I'll use that opportunity. Does anybody have any questions about the accounting equation?
No.
Okay. All right. Those of you that I can't see, everybody okay? Caden, Austin?
Doing good, thank you.
Okay, awesome.
Yep.
Perfect. All right. So we'll forge ahead here. So our money bucket accounting system, exact same idea as before, only now we're looking at relabeling. Assets equal liabilities plus owner's equity. Okay. Our liability, and I'm not going to go through all those transactions again on the screen right now. They're still the exact same. But our liability would be Dad's claim. Our owner's equity would be the two owners, my claim and my sister's claim. You might say, well, is it a big deal? I mean, what if I label the accounts in the wrong place? Maybe I'll put the cash right here. Yeah, and we'll find out why here in a second. So, like I said, I'm not going to run through the transactions again just yet. They'll be the exact same as I showed you before. All we did was kind of switch around our terminology there. We'll do the transactions again here in a second. So our balance sheet, we're going to update the terminology on that. Our old one with the layman terminology, we're just dropping in the new terminology. Assets, liability. Notice instead of Dad's claim, it says note payable. We owe Dad money. We have a note payable with Dad, just like you could have a note payable at the bank and owe the bank money. And under owner's equity, instead of my claim, sister's claim, we've got my equity, sister's equity. So we're just tweaking the terminology. The accounting that we looked at, nothing has changed right there, just making the terminology a little more real world. Making it just like it is out in the real world. And to prove that point, I got proof. You don't just have to take my word for it. I brought proof. I brought chapter and I brought verse here. Okay. Any of y'all got an iPhone or an iPad out there? Hey, Mark?
Yeah, I got an iPhone.
Okay, so, hey, John, what was that? I missed that. I think you were saying, yeah, he has an iPhone.
Yeah, I have an iPhone.
Okay. So a lot of y'all got the iPhones out there. I don't make iPhone money. I've got some kind of weird Google Pixel 2a phone or something like that. But what I have in front of you is a balance sheet for Apple. Apple Incorporated. I took it right from their corporate financial reports, which are public information. And you can see it right there, balance sheet. And these numbers are in millions. Okay? Right here at the top. Assets, liabilities, and equity. So you have had 30 minutes of an accounting training. And you could take a balance sheet from a real world corporation and start to understand what's going on. The assets that Apple owns are all right there. Who has a claim to them? Liability, the creditors, and the owners of the corporation, who are the stockholders, which we'll get into later on. But if you just take a look, they got a cash bucket. At Apple, they have a cash bucket right there. Right at the top, cash. $48,844. But I told you, this is in millions. So I'm going to add 6 zeros to that. As of 2019, at the end of the year, Apple had $48 billion in their cash bucket. So those of you that have an iPhone, when you buy your iPhone, if you ever thought to yourself, why the heck does this thing cost $800? Well, it cost $800, so Apple can have $50 billion in the bank, which probably makes you feel a lot better about what you paid for your iPhone, right? They got investments, they've got inventory, they've got buildings. All those are assets, right? And then look, they have some debt. They've got some payables. They've got liabilities there that they have to pay back at some point. So what I'm saying isn't like, okay, wink, wink, this is how it is, and then a year from now you're going to learn what it really is. The stuff I'm showing you is directly applicable to business right now, everywhere. Businesses large and small follow that accounting equation. Their reports revolve around that idea. Assets are equal to liabilities and equity. Right on? 48 billion with a B. Probably even more now. That's a couple years old. Anyway, I got to make one more adjustment to our accounting system. Okay? We're kind of adding things to it a little bit to make it the way it is in the real world. Before, we had these little upside down L's. Every account, we kind of gave an upside down L to, and then we'd put stuff in or we'd take stuff out as we went along. Right? We did our transactions like that. That's not the way it's done in the proverbial real world. In the real world, every account has two sides to it. And I don't know if I should throw this out there or not. We'll see if anybody can take it. Anybody know what this account format here is called?
Is it a T something?
Why do you say that like you're questioning yourself?
I remember it
A
being
teacher.
called a T or something.
Yeah,
Teacher.
absolutely. It's a T account. It's a T because it looks like a T. And the feature of a T account is that it has two sides, doesn't it? Not one side, but now we have two sides on every account. Our cash account will have two sides. Our claims or equity accounts will have two sides. Every account has two sides. So we need to learn about these two sides. Now, some of you probably have a preconceived idea or notion of what the word debit means and what the word credit means. Like you have raise your hand if you have a debit card. Okay, we got debit cards. Yeah, thank you. Those of you online, Hunter, Bryce, yeah, we got debit cards. Anybody got a credit card? We got credit cards. We probably have some idea of I go to the bank and I put money in. They're going to debit my account. They're going to credit my account if I take money out. All this different stuff. What I want you to do for me, everything that you know about debit and credit, I want you to forget about it. From now on, the only thing I want you to understand about debit and credit is what I'm getting ready to tell you. And it's really, really complicated. And so take a deep breath and be ready. I see two hands here before I get into that. Are you just agreeing with me, Hunter and Kaden, or do you have questions out there? Yeah. Okay, I asked them to raise hands. I just want to make sure. Thank you, Phil. What I want you to know about debit, and I need your help here. If you could, don't do this on the chat because this is more of a physical exercise. So do this even if I can't see you. I want you to raise your left hand in the air. Okay, so your left hand is in the air. And I want you to say debit. Okay. All debit means in accounting is left. Literally. Debit means left. That's it. That's all it means. Don't associate any other meaning to that word except left. And raise your right hand. And then say the word credit. That's all it means in accounting. Credit means right. We have two sides to an account. It doesn't matter what account we're talking about. The debit side is always the left, and the credit is always the right side. And where people get into trouble in accounting is they want to associate debit with something other than left. I'll give you an example. Oh, debit always means it goes up. No. Credit always means it goes down. No. Credit means right. Debit means left. That's all it means. Period. That's the side of the account. Left, right. So don't associate a movement. Don't associate anything about in and out. Debit is left. Credit is right. So brainwashing. That's all I want you to know about it. Debit left, credit right. So let's take those transactions. We'll put them in the T accounts here and see if we can make this happen. We're not using pluses and minuses. From here on out, where we put the number, left or right, determines if the account's going up or if it's going down. Okay? No pluses, no minuses. Where we put it, that makes the determination up or down. Sounds confusing. I'm going to give you a general rule of thumb. If the account is on the left-hand side, if it's an asset account, on the left-hand side, it goes up on the left-hand side, or the debit side. So if the account lives on the left-hand side of the equation, it goes up on the left-hand side of the T account. If the account lives on the right-hand side of the equation, it goes up on the right-hand side of the account or the credit side. I'll give everybody a second to jot that down because that's critically important. The number one problem people have in accounting is I can't remember what side makes a number go up or down, an account go up or down. So it takes a little bit of memorization at first. It takes a little bit to getting used to, looking at your notes until you get the feel for it. Probably not something that's going to be just intuitive right off the hand. So if you find yourself getting a little bit of frustration, just give yourself some time. It'll click. But it's not something that's just common sense. So it might take a couple tries for it to click. Everybody got that down that wants to get that down there? I think we're good. All right. So we'll put all that together and take everything that we've just talked about and put it into our accounting system in a way that is more like what we see in real life. Assets equal liabilities plus equity. The accounting equation, again, very important where I put my account titles. I just can't throw them in there willy-nilly. I've got a cash account. I've got a note payable that represents the amount of money I owe Dad. And I've got my equity. And my sister has equity. I give everybody a chance to set up some T accounts here. And we'll fill these out and we'll be done. It's been a flurry of accounting activity. I appreciate everybody hanging in there. It's not easy to sit and listen to accounting stuff for an hour or so. Everybody get their T account set up and then we'll label them a little bit. Okay. Debit on the left, credit on the right. So I'm going to go ahead and label. I'm going to go ahead and at the top here, I'm going to put DR, and I'm going to put CR, just to start getting used to the idea. Debit on the left, credit on the right. DR is the abbreviation for debit. If you want me to go full on accounting nerd, you might look at that and say, how'd they get DR out of debit? The original word for debit in Latin was debitar. And so that's how the abbreviation came forth, was because debitar, shortened, was DR. And that's kind of how long this accounting system has been around. It dates back to like 1400, double entry accounting does. I can't remember the guy's name that came up with it, but you can imagine coming up with something in the year 1400 and people are still doing it in the year 2020, 600 years later. That's pretty wild to think about. We've not come up with anything better. They were putting leeches on people for medical treatments back then. And we figured out that's not the best way to do it. We haven't figured out a better way to do accounting. So props to the guy that came up with this like 600 years ago. I'm going to go ahead and put some pluses and minuses in here. We said if it's on the left-hand side of the equation, it goes up on the left-hand side. So I'm going to have a little plus right there by that debit. Meaning when I add to the cash bucket, I use the debit side. When I take out, I use that credit side. On the right-hand side of the equation, it goes up on the right. I'll put a little plus by my credit and a little negative by the debit. There we go. We've labeled our accounts. We have 4 different accounts. They're all nice and set up. We've got pluses, minuses on there to kind of help guide us. And now we're going to take the 6 transactions that we did before and we're going to throw them in here. Okay? And so this is where I'm going to rely on you all because I've talked for so long. I'm out of water. I just don't think I can go anymore. So transaction number 1, we come along, we put $200 into the money bucket. So I need a debit and I need a credit. So what am I going to do here? What would my debit be? Everybody got shy on me all of a sudden.
Are we supposed to answer that?
Yeah, I mean,
Okay, yeah, debit goes in the assets, $200, and then wouldn't it go to the credit of my equity?
Oh, I love it. Perfect. Thank you, Ryan. So we're going to put, for number 1, 200 on the cash debit, and we're going to credit my equity, 200. Now, you can imagine the 10 Commandments and Moses coming down the mountain with the 10 Commandments. We have accounting commandments. And it's not exactly Moses coming down the mountain, but we have rules in accounting that we always have to follow. One of them, Ryan just kind of demonstrated here, this equation has to stay in balance at all times. Okay? And it does. The way that it does that is every transaction that we make, it has to have an equal amount of dollars on the debit side and the credit side. Debits always have to equal credits in dollar amount. I could have 10 debits and 1 credit. That's cool, as long as they equal in total in dollar amount. So I have 200 on the debit side, I have 200 on the credit side. It's equal, it balances. If you ever do a transaction where it's not balanced out, you have more dollars of debits than you have credits or vice versa, it's wrong, period. There's no way it can be right. Debits have to equal credits, always, when you make a transaction in dollar amount. So everybody clear on that? Awesome. Number 2, we'll go ahead and fill that one in. Ryan kind of showed the way there. So we'll put $150 in the cash bucket. And we'll put 150 under equity for the sister as a credit. Easy, right? People get paid to do that? Where's the challenge? All right, so number 3. Sibling comes along. She takes out $20 out of the money bucket. Anybody want to tackle that one and give me a debit and a credit?
Wait, who takes it out?
Okay. So we'll take that 20 and credit cash. We'll do a little 3 right there. What about the other side of it?
Is it the sister taking it out or?
Yeah, sister's taking it out. So is that going to be a debit or a credit under?
That'd be a debit.
All right. Yeah. So I'm talking about number 3. So we're taking 20 out of her equity because she pulled that money out. So notice we have the cash account going down. So the asset side's going down and then the equity side's going down. Both sides going down 20 bucks. We come along, same idea. We take out 15. So I'm going to credit the cash account 15. I'm going to take my equity down 15 with the debit. Debits and credits are equal. 15 on the debit side, 15 on the credit side. That's the magic that keeps our accounting system in balance. It's a double entry. We have 2 sides working together to keep everything in balance. All right, 2 more here. We're going to run out of time in about 15 minutes, so we'll kind of move along. Number 5, Dad loans 100 to the bucket. So we have money coming into the bucket. And now
Be on 100 for credit of note payable.
Yeah, 100 credit for note payable. Good. I like it. We're getting it. Accounting is happening. Thursday afternoon. A little misty-eyed just thinking about it. So perfect. We debits and credits. We're still in harmony. I got one question there, so let's go ahead and go to Hunter. Hunter, go ahead.
All right, so I may have missed this part, but why is the debit positive on the asset side and negative on the liabilities and the owner's equity?
Okay.
I definitely missed it, but I want to know why.
And so, and that's perfect. Yeah, I want you all to ask the questions like that as we go along because it's important we understand. So, Hunter, the idea is if the account is on the left-hand side, okay? If it's on the left-hand side, it goes up on the left-hand side of the account. If it's on the right-hand side, it goes up on the right-hand side of the account. And so it's almost like the accounts go up and down according to the side of that equation that they're on. Did that kind of help?
Yeah, thank you.
Okay, no problem. Like I said, it's not common sense. And so it may take a little while, especially what makes it go up or down. It takes a while to get used to that. And so don't get frustrated if it takes, a couple tries to say, okay, I see what's going on here. Number 6, we take 25 out of the money bucket. We're taking money out, so goodbye money on the credit side there. And goodbye dad's claim. We got a debit, making dad's claim go down, and note payable. We got a credit, making that cash bucket go down. So that's chapter 1. The final thing we need to nail down, well, how do we calculate an ending balance in an account? The whole point of these accounts is to keep track of what's in a particular account. How do we calculate an ending balance? Now I'm going to show you real quick. Best way to do that. I'm going to kind of draw a line here to indicate that that's the end of whatever period we're looking at. Start on the positive side, whatever side's the positive side that we're looking at. Add those up and then subtract out the other side. We should end up with a positive balance in every account. $75, $185, $130, and we have, what was it, $390? Ooh, man, that got boogered up. Z90. So those are your ending balances. Very important. Make sure you put the ending balances on the side of the equation, the side of the account they're supposed to go on. So the positive side is the normal side. That's usually where your balance is going to show up. We got 390 in assets. All told, we got 390 on the other side. Whew. I said that's a flurry of accounting activity. I understand if everyone needs a nap after this. I think I need a nap. And I knew where this was all going. I still need a nap. Any questions about it up to that point? Anybody okay? Kind of, maybe? Maybe a little practice and we'll feel better? Okay. Did I go too fast? Everybody get down what they needed to get down right there. I don't want to take something off and have people. Caden has a question out there online. Caden, what can I do for you?
Sorry, that was just a thumbs up.
Oh, okay. All right. So we're almost to the end here. Just a couple more thoughts. We had a balance sheet, and we're going to add one more report to that. This is kind of what it looks like if you go through and do the clicks in solid footing. I just copied it and pasted it. If you go through that spreadsheet for solid footing and do the little buttons, you end up with what you see at the top, which is basically what we just did and wrote down. I told you all on Tuesday, I think it helps to write stuff down, maybe process it mentally as opposed to just clicking and looking. But if you did want to click and look, that's what it looks like. The next report I'm going to show you isn't really a report we give to anybody. It's a report the accountant uses to make sure that the accounting system is in balance. And that's called a trial balance. Literally, it's just a report that tries to see if we're in balance in the accounting system. What that means is, does debit equal credits in total in our accounting system? And we do that before we make our balance sheet and our other accounting reports, because if we don't, and the accounting system's not in balance, then we're wasting our time because those statements aren't going to work anyway. So our trial balance is a listing of every single account in the accounting system and what the ending balance is. So I got one set up right here. Trial balance. Here's all my accounts. And I'm just going to take the ending balances and plug them in on the correct side. 390, 75, 185, and 130. And then we total them up. The idea being, when we total them up, debits ought to equal credits. 390 equals 390. If those don't equal, we have a problem somewhere that we've got to go back and fix before we can make a balance sheet, before we can make any of the other statements that we're going to introduce later on. That's the trial balance, trying to see if we balance. And you may think, well, that looks a lot like the balance sheet. Why are we doing something that looks exactly like what we've already done? We're going to add more accounts. And some of the accounts we're going to add later on won't show up on the balance sheet. But we still need to include them in the trial balance to make sure everything balances. So it may be confusing if you think, well, that looks exactly like what we just did. Why are we doing the same report twice? We're going to add to this trial balance accounts that won't show up on the balance sheet. Then they won't look the same anymore. Or similar, I should say. So we got the balance sheet, we got the trial balance, we've got debits, we've got credits, and all kinds of stuff going on. I made a comment. We use that to make our reports. We'll get into that later on too. That's it. That's chapter 1. And it's kind of amazing that they can do that in like 10 pages. You know, all that stuff. So the summary of it, really important, must remember, don't ever forget things in chapter 1. And if you can think back a few days from now and you have these down, great. First of all, that accounting equation. Assets equal liability plus owner's equity. A equals L plus E. So that's your dinner conversation right there. Don't say stuff and claims and stuff. And if you want to talk about it over dinner and impress everybody with your accounting knowledge, you'll be like, hey, I was looking at the Apple balance sheet today, and really followed that accounting equation really well. Assets at the top, people are like, wow, you're that smart after one day of college? Scary to think about what you're going to look like in a year or two. The other point, I said I wanted to brainwash you. Yeah, I only wanted you to know one thing about debits and credits. We said debit was on the left, credit's on the right. So when we get those T accounts, we know the debit side is always the left, credit side is always the right. That's all it means. Debit on the left, credit on the right. And the accounting commandment for today, anytime we make a transaction, debits and credits always have to be equal in dollar amount. Got to balance. And that's kind of what I was alluding to on Tuesday when I said, it's not about math. It's about organization. It's about harmony. It's about balance. It's about, all of that. It's yin and yang, Zen kind of thing going on in accounting here. But that's it. That's chapter 1. Any questions that I can answer before I show you the homework real quick?
I need to use the bathroom real fast. I don't want to miss this.
Okay. I'll try to be as quick as I can. Solid footing problem 1-1. Let me show you how to download the work paper. I showed you how to activate it, but I'll kind of show you what I'm looking for here, and then I'll turn you all loose to do the homework, and we'll talk about chapter 2 on Tuesday. So let me pull that up here real quick. In Canvas, you'll see Solid Footing Chapter 1 homework. If you click on that, you bring up a window that looks like what you see right here. The instructions are in a PDF. Go ahead and kind of show those to you. We have a coffee can accounting system, so we've been downgraded from a bucket to a coffee can because apparently we don't have enough money to fill up a bucket. But read your instructions. Every time you do solid footing, please read your instructions because it tells you what accounts to put in and how to set them up. So you can read the narrative, label your accounting equation, label your accounts, debit and credit, plus and minus, put all that stuff in you want. And then you're going to record these transactions. Compute your ending balance, make a trial balance. The worksheet for that is right there. So like we talked about earlier, I showed Ethan, you have to activate it. When you activate it, you can type into it. So you have your accounting equation at the top, set up your accounts, put in the transactions, and at the end, calculate your balances, and then do your trial balance. Ending balances, make sure they equal debit and credit. You put your name in it. You don't have to put the section or the number in it. Don't worry about that. But that's kind of the idea. You'll save that, and then you'll upload it to that link in Canvas, and that should take care of the homework for Chapter 1. Now, I want to point out one weird thing on that homework. In the instructions, you'll notice you put in money and you get a loan. And then it says you take all the money out to go on a trip. That little note says it's okay for the My Equity account to have a debit balance. That will actually take you into the negative on My Equity. But you'll put the money back and you'll go back to a positive. So don't freak out. It's a little bit different than maybe the easy example that we looked at. But just be aware that for that one little brief moment when you take that money out, it will turn your equity account negative on the debit side. So, all right. Any questions? And then Ryan, you can take off if you need to. I have nothing else to say other than answering questions. Anybody have any for me? Mary's good. Alex, you okay out there? Good. Ethan, you okay?
Yep.
For those of you that I can't see, everybody doing okay?
Yep.
Okay.
Yep.
I have one question.
Okay, go ahead.
When I'm in Canvas and I go over and hit courses, I don't see all those tabs after.
Okay, so let me go back here. I may not be in student view. If I go to student view, it should look a little bit more like what you're seeing. I was in my view. So yeah, there you go. That's probably more of like what you're looking at, I'm guessing.
Yes, that's what I see.
My apologies. I didn't realize I had turned off that view. Anyone else? Okay. If you if you're working on Chapter 1 homework, you have any questions, feel free to reach out to me and we'll try to help you. Ryan, you did have a question there?
I do. Can we submit that early? Like, can I do that homework tonight and submit that?
Oh yeah, definitely. When you get it done, send it my way. You don't have to hold on to it.
All right, thank you.
Yeah, I would definitely like to have that by Tuesday before we start class. That way we can go ahead and get going with Chapter 2. Give me some time to look at and make sure we're all on the same page. Also, if you could take a look at that reading for Solid Fitting Chapter 2, we'll continue on with that on Tuesday as well. Anybody else?
I did come in late. I had internet problems, so I might actually have some questions later. I'll have to rewatch the video just to get caught back up.
Okay. Yeah, not a problem at all, Brandy. Do you know how to find the recording for the videos?
Yeah.
Okay. Yeah, you're good to go. Take a look at it. If you have any questions, look me up.
Okay.
All right. everybody have a great weekend, and we'll see you back here on Tuesday for Chapter 2. Thank you for your time and attention. Appreciate it.
Thank you.
Thank
Thank you.
you.
See you later.